All right, let's talk about a climate policy that is so massive, it's literally changing the entire global game. We are diving in to China's National Emissions Trading System. It's an absolute giant, and you're going to want to understand how it works. So, let's get right into it.
Just think about this for a second. What if a single policy, just one, could put a price on carbon for over 60% of a superpower's entire CO2 output? Well, it's not some far-off idea. It's happening right now.
And yeah, you guessed it. That policy is China's National Emissions Trading System, or ETS for short. It's this colossal, market-based machine designed to help steer the world's biggest emitter towards some really ambitious climate goals. We're talking peaking its emissions by 2030 and hitting carbon neutrality by 2060.
To really get a feel for why this is such a big deal, you first have to understand the sheer scale we're talking about here. It is, by a long, long shot, the largest market of its kind on the planet.
Get this. Even before its recent huge expansion, back when the system only covered the power generation sector, it was already regulating over 5 billion tons of CO2 every single year. That number alone made it the biggest carbon market in the world by volume, completely dwarfing all the others.
But it's not just the size that makes it so interesting. China has taken a really unique approach to how it's designed. It's fundamentally different from the systems you might be used to hearing about, like the one over in Europe.
So, let's do a super quick refresher, right? An emissions trading system, or ETS, is basically a market for pollution. The government sets a limit on emissions, and then companies can buy and sell permits that allow them to emit. It creates a really powerful financial reason to pollute less, because if you can clean up your act on the cheap, you can turn around and sell your extra permits for a profit.
Now, most systems, like the EU's, set a hard cap on the total amount of CO2 that can be emitted. Period. It's an absolute limit. China's system started differently. It's what's called rate-based. This means it sets a limit on how much CO2 you can produce for each unit of whatever you're making, like per megawatt of electricity. Think of it as a pollution per product rule. It's a clever way to push for more efficiency without necessarily slamming the brakes on production, which, for a growing economy, is a really big deal.
So how does that actually work on the ground? Well, the government sets an efficiency benchmark. Let's say it's 1 ton of CO2 per widget. If your factory is super efficient and you only make half a ton of CO2 per widget, great. You have extra allowances you can sell. But if your factory is old and inefficient and you're pumping out 2 tons per widget, you've got to go out and buy allowances to cover that extra pollution. It really pushes everyone to get better and upgrade their tech.
Now, a system this complex and this massive didn't just appear overnight. Not even close. China's approach has been really methodical and deliberate. It took over a decade of planning, piloting, and careful preparation to get here. This whole journey really kicked off way back in 2011. Then, from 2013 to 2014, they launched 7 different regional pilot programs to kind of test the waters and see what worked. It wasn't until 2021 that the national system finally went live, and even then, it started with just the power sector. This whole slow and steady rollout was all building up to its most significant move yet.
And that brings us to 2025. This is the year the whole system took a giant leap forward, expanding its reach and really cementing its place right at the heart of China's entire climate strategy.
For the very first time, the ETS moved beyond just power plants and brought 3 industrial heavyweights into the system: steel, cement, and aluminum smelting. And these, as you can imagine, are incredibly energy-intensive industries and major sources of carbon emissions.
Just think about the impact here. The power sector alone was already about 40% of China's CO2 emissions. By adding these huge industrial sectors, another 20% got brought under the system's umbrella. So you do the math. A single policy now directly regulates over 60% of the entire nation's carbon output. That is just a staggering level of coverage.
And with this expansion, the market is also starting to mature. The price of carbon is climbing, moving from under 80 RMB to now over 100 RMB per ton. And that's not just a number on a chart, that's the market getting some real teeth. A higher price means a stronger financial penalty for polluting, which in turn pushes companies to actually invest in cleaner technology.
So, with this massive expansion now in the books, what's next? Well, the system is still very much evolving, and there's a pretty clear roadmap for the future.
So what's on the to-do list? Well, the big one is a potential shift to an absolute cap on emissions, much more like the EU system. Enforcement is also getting tougher, with bigger penalties for anyone who breaks the rules. And China's domestic carbon offset market, called CCERs, is making a comeback. This lets companies invest in green projects like forestry to cover a small part of their emissions. All of this is really paving the way for the ultimate goal, potentially linking China's market with others around the globe.
Which, of course, brings us to a final, pretty provocative thought. As the world's largest carbon market keeps growing in scale, in sophistication, and in financial weight, could it one day become the primary benchmark? I mean, will the road to global decarbonization actually be priced in Shanghai? It's a huge question, and the answer is going to define the next chapter of climate economics.